Gentlemen, good morning and thank you very much for joining me today. We've done this a few times, me and you, Tiaan.
It's not our first rodeo.
Not our first rodeo, and I'm very happy to have Trevor with today. We met, only a few months ago?
We met, it depends if you count meeting on social media, we met well before
yeah,
that.
then
yes.
we met well before that. So gentlemen, just for the audience that will be looking and checking out our YouTube channels and everything, please give us a short introduction of who you are and what you do.
My name's Trevor John, I'm head of Old Mutual International, and we work within Old Mutual Wealth, and we help South Africans get their money a job offshore.
Fantastic.
My name is Tiaan Herselman. I work for Old Mutual Wealth, and I look at our entire offering end to end and hopefully try and simplify it for clients and financial planners out there.
Great stuff. Thank you very much. Both of these gentlemen very knowledgeable, and we've had some interesting conversations. Actually, we had quite a long conversation before we started. And just to take it further from that conversation, let's jump into that first. The question was in terms of fees, fee structures, costing, etc., with regards to investments. It seems that there's a discrepancy in terms of the different investment platforms. I mean, Old Mutual has a variety of investment platforms. You've got Old Mutual Wealth, you've got Old Mutual Max Investments, Unit Trust, OMI, etc. And then as a financial advisor and very often as clients, when they look at these investments, to them it is perceived that there's different ways in which these investments are costed and fees are charged, and that one product might be more expensive than another product. Would you care to just try and explain it in a bit more simpler terms, if this perception is correct or incorrect, and then, let's see what we can give the people out there with regards to it.
I think this is why it's super important that I'm a fundamental believer in advice and advisors. I think there's this tendency for people to want to do things themselves. And it's because you can get, and that's fine, like depending, you just got to be very conscious of your circle of competence. So like even if you are an investment professional, I think of accountants who haven't got their own finances sorted out, or actuaries who think they've studied it so they don't need a financial planner. My favorite question is asking a financial planner if they have a financial planner, because then it's someone checking you for your own blind spots. When it comes to all of these questions, I think it's the first pushback. Someone's always going to go to fees, and fees are important, certainly. You know, like you don't want to be overcharged, but you need to understand the full context. So with a bigger house like Old Mutual, we're certainly not going to be talking about specific products on social media or areas like that, because you know that the tendency for people to hear something that triggers them and gets them on another tangent. When the financial planner is looking at it, they're going to get to understand the client, and they're going to get to understand their set of needs, and they're going to work with specialists. So we have an army of specialists who talk to each other. So we will tease out the stuff behind the scenes. We have each of these bits of Old Mutual that you talk about have almost a specific set of clients that they focused on. So the one thing with, I'm a passionate Old Mutual person. I started in 2000, and one of the things that appealed to me is it's this warm place where the line that I like is there's a green roof in every town in South Africa. It's part of the system of South Africa, which means that we extend all the way from mass market products where every South African can have an exposure to Old Mutual, to the area that I sit in, which is someone who's got a lot of wealth and they're looking to diversify offshore. They're building intergenerational wealth. That's why you go into these different product sets that are normally designed for specific needs. And then when you're looking at it as a client, you need to sit down with the financial advisor. Yes, there's also, you can go directly yourself in very contained environments where you know exactly what you're getting. But that's really the reason why there's different costs involved, is because setting these things up, there's different dynamics. Some of them have very complicated structures that they need people to be involved in. But you can compare it like financial advice, or actually anything where there's money involved, effectively has a problem that you're trying to solve, and it needs a container to solve it inside. And there's various people who are, it's not unpaid work. So it's not like your mom looking after you or something like that. There's a reason someone's helping you, and they have to make those kind of economics work. So between that, then the product has to make sense for the client and for the people who are making it work, and that's the dynamic you go through. So what we do as market supporting people is we try have different areas we focus on, because we're people with constraints, so we can't know everything. And so my area that I focus on is that conversation between an advisor and their client. So what's happening in that conversation? How can I support it? And the advisor's the key pin for me, because they're sitting listening to the client, figuring out what their needs are, which is all unique. So clients, have a set of circumstances that you're trying to manage, and the advisor needs to make sure that they get support behind the scenes from specialists, from product people, from legal people, from accounting people, there's an army behind a financial advisor. And we try to be that army who can provide then the products for the clients. And there are these kind of little technical differences, which is why I think unless you're going to get like super passionate about this area and do it for yourself, you've got to admit that it's a rabbit warren. Like there's lots of complexity, and you're never going to get like a tweet length answer that actually unpacks everything. And you have to do it calm, methodically, find a situation that works, and that's what we focus on with advisors.
A lot.
That was a very thorough take. I quite enjoyed that. Look, for me, if I think about the fees thing, is the first thing, as Old Mutual, we're very transparent. So any document that you have, any investment you take out, will give you something called an EAC. EAC is an effective annual cost. So you can see over 1 year, 3 year, 5 years, 10 years. It's an industry standard that we tell you, this is the fees. And normally, if you look at fees for me, there's kind of, depending on the product you go into, I don't want to talk about products because it's about the advice you get. That's the value a financial planner adds. But depending on the product or the solution you go into, there's normally 5 levels of fees. There's, what am I paying the platform? So that could be Old Mutual Wealth. It could be Old Mutual International. It could be whoever. What am I paying my financial planner? And there's a fee scale for that. What is the underlying fund that I'm going into? What's that fee? And that's normally called the asset management fee. And then there's some other fees depending on the product you go into. So it could be, do I have a brokerage account where there is trading cost? And if you go into a fund, that's in the asset management fee. But if you're going to a direct stockbroker, they would actually charge you that fee for every trade, or direct trading platform. And then there could normally be some forex where I'm taking the money out of the country. So those 5 fees we are quite transparent about. When it comes to different solutions or different people, that's where it becomes a bit different. And somebody might look at one fee structure and say, well, my EAC is 5%, and go, that's a lot. But in your bucket of investments, there's a hedge fund component. And because of your risk profile, your objectives, you want hedge funds, and hedge funds are more expensive in the industry. Somebody else might say, I'm investing for the long term with you, Corné. I want to go passive, and now your EAC goes down. Now, depending on what the market did for that typical year, if you look at this year, markets are up. What would have happened? Hedge fund would have underperformed. The passive fund would have outperformed. But go back 2 years ago, the hedge fund would have outperformed and the passive fund would have underperformed. The reason I mention that example is because fees aren't the only thing to look at. And I think that's where, yes, there's different product sets in the industry, but the one thing we are trying to do is simplify it to an EAC. What am I paying for? And that really is where the financial planner can also help you simplify all of this. So yes, there'll be different products for different needs. And they'll all have the same EAC.
Yes.
Whereby we break it down, this is the fees you're going to get charged for that particular product. And I think the one thing we are very passionate about as Old Mutual Wealth, and I hope I can say Old Mutual International, but I'm sure I can, is that we're trying to simplify that, but also explain it and articulate it in more detail. Because again, if you're going, as an example, passive where you're buying the market, you are going to pay much less than somebody who's a retiree saying, this is my nest egg, I want some more active decisions being made to make sure I protect on the downside.
Yeah, I listened to the two of you, and I suppose there's never a simple answer to something like this. I try and explain it to clients as follows when I do talk to them. As I try and say to them, if you get a sore throat, you will go and get yourself an over-the-counter Strepsil. And you've got a bit of a cough, you'll buy yourself a cough syrup, and you will self-treat yourself. But the moment that doesn't help, and now suddenly it becomes worse, you will go and see a doctor. And you will pay more because you need a more specialized answer. And that's my analogy that I use. I don't know if that makes sense, but that's me.
No, but I think, Corné, to your point, investments, as much as we like to simplify things, and the one thing I love about Trevor is him and I both have a hate for acronyms. We think there's too many acronyms in the investment industry, but investments are complicated because the world 25, 30 years ago did not have things like ETFs or cryptocurrencies, or maybe there were some hedge funds, but not really in the local market. There's all these new things, and what we're trying to do is put it into a investment for a client and say, look, these things are different, but at least the way in which we measure it and we give you the fee breakdown is becoming standardized.
Yeah.
But financial planning and investments are complicated, as much as we try and simplify it.
This is the thing, we all rest, I think all of us love stories, and actually at the heart of what we love is connecting to people. And I think the stories only really work when you connect some. My favorite thing is actually first listening to someone to find out what they're passionate about, and then trying to figure out how to put the story in that form. The other, just be careful to over try and get story. I do it. You can see my first answer. You get passionate. You use too many words. Like investing, the one that I say is get your money a job, because I think that's cutting through all the noise. That's what we're doing here. I think we try and predict the future. We try and make out as if this is gambling. We get excited, like all our animal spirits come up. But actually, what you're doing is work.
Yes.
And so why are you panicking about fees, or why are you panicking about the investment choice? At the heart of it, it's about you, and like you don't want to get it wrong, and you're stressed. And it's actually quite simple, just like you choose a job, get your money a job, and it's all this other stuff is there, and we can't oversimplify it. So while we're trying to get a story that you can buy into and do it, there is complexity. And we're not going to get rid of it.
No.
But that's why just get some help from someone you trust. They're going to be figuring it out too. So your financial advisor is a step ahead of you, but I can promise you they're wrestling with questions. We're wrestling with questions. We haven't solved this. No one has. So actually be most scared of the person who makes out
that he
is
knows
it's completely
everything.
solved, and this is what you must do, and they don't even listen. They don't ask you any questions. If the person you're speaking to hasn't asked you a single question, you get out of Dodge.
Yeah. No, I agree with you. Well, thank you. Let's move on from fees. Otherwise, we're going to be stuck on fees for the rest of the day. So, seeing that we have friend Trevor here, I would like to know, or I would like you to give me an explanation on how OMI strategies work in the investment world and how it differs from other investment houses.
So the nice thing I like about, you get into investment, it speaks to what we were saying earlier, is you often believe what's happened to you, that's why you believe what's happened to you. You see what you've seen. And so why I like Old Mutual International and Wealth is what our goal is to be there to support advisors and clients. That's what we're selling. I'm not telling you this is a right philosophy or the wrong philosophy. And I'm sitting in the privileged position of being able to listen. So quite often, the reason someone can't change their mind is because of the salary they're receiving. You can't, if you get paid to believe something, you're going to believe it. So the nice thing about what I do is I can just listen. And we have a philosophy that is built around actually a product that's almost like a Tupperware. You can put whatever you want in it. So what we're doing is quite simple. It's the admin. So if you want to go offshore, it's like getting a visa or a passport. There's paperwork. We help with that. And because we help with that, that allows us a container that allows the advisor to support you. And then within that container, you can put whatever you want. So I'm not going to force you into one particular investment or another. I'm going to ask you questions to make you think about what you want. But there is the whole world in there, all the way from super passive to very aggressive, active decisions that are going to... So the heart of what I'm trying to figure out is what's going to stress you out. Like managing someone's expectations is the biggest thing in investing. Is like, why are you going to make bad decisions in the future? And let's not set you up for that. So let's really understand what it is you're trying to do, which is get your money a job. But how do you think about things? So that might be someone who's super passionate about stocks. Then I'm going to get you a portfolio manager. Do you want to make the decisions, or do you want someone to make them for you? Then you're going to get a discretionary account where you can make those decisions, or someone else is going to, all the way through to a passive investment where actually you go, I want the minimum fee possible, I don't want to underperform my neighbor, and I want to crack on with something else that's more important to me.
So if I hear you right, in terms of your strategy at OMI, it's not a fixed strategy. It's not a strategy that says, okay, we only believe in buying value assets and holding it and then selling it. You guys are pretty flexible. I almost want to say liquid, because it's not about a specific strategy, it's about the person and trying to match whatever their need is with your investment that you can offer.
100%. Like, I'm a person, so I have my own personal beliefs. So like, if I realize you want to know what I think, I'll tell you, but I'm not going to force that on you.
Yes.
And there are, within our universe, there's certainly some very fixed opinions and people who have very strong views. So if you actually say, come on, man, you're too fluffy, you're just trying to sell me whatever's available, I'll go, no, okay, so you want some views. The reason, I think a big danger is hard sell. When I I'm not going back to, I'm not listening to you, and you've actually bought the wrong thing. That's the thing that I try and avoid. So it's flexibility where we need to be flexible and strength where we need to be strong.
Yeah, and maybe to add to that, if you make it a bit more practical, and please tell me if I'm putting words in your mouth, but you've got almost a philosopher and the practical person here. You know, it's such a beautiful relationship, Trevor and I. But if I had to take it down and just make it practical, for me, OMI says if I want to get my money a job offshore, like Trevor says, as an SA taxpayer, I can do that. I can do it in different currencies. The money leaves the country. It can pay out in countries all across the world. I can have access to different investment options. Like Trevor mentioned, I can go active, I can go passive, I can have a bunch of funds together, I can have a portfolio manager. And if I were to pass away, there's immediate liquidity available for my beneficiaries. The great thing is if they are also SA tax residents, then they take over the contract immediately and there's no executive fees involved because there is a life insured. The money gets paid out in hard currency and you take your capital, you take the risk out of being invested in an economy that makes up 0.4% of the global economy. So we physically get your money a job offshore. And to Trevor's point, we make the admin involved, we simplify that. The other thing I think is also important to note is a lot of people don't know that if you hold direct stocks across the globe, let's say you hold Apple, Nvidia, Tesla, any of the Magnificent Seven, any stocks on the US index, if you pass away, there's quite a big cost to that. And the cost isn't just SA estate duty of 20 to 25%. There's something called CITES tax of up to 40%. Now, all of a sudden, you are the spouse available. Trevor and I are happily married. Trevor built this beautiful stock portfolio because he loves active investments. And I go, great, I'm going to inherit the stock portfolio from Trevor. And then I find out the money's in a stockbroking account offshore. I've got to pay 40% tax and I've got to appoint somebody offshore. An offshore solicitor, they call that the process of probate. And what Old Mutual International does, it takes away all of that complexity. Yeah. But to Trevor's point, whatever your views are on how you want to invest, that's where the OMI team can help you. So, Corneille, you might like a more passive approach, you might like a more active approach, and we could even do it soon for 10,000 Rand a month.
Yes, I believe so. I'm looking forward to that, 100%. So the next thing I want to move on to is something that I find that portfolio managers, investment houses don't not necessarily want to talk about. And that is cryptos and alternative investments. Now, I think this is more for you, Tiaan, this question.
Are you giving me the hard question?
I'm giving you this one.
Okay.
In terms of cryptos and alternative investments, why are investment houses so reluctant to invest in that, to expose their portfolios to these investments? I mean, and I've got a follow-up question on this, so I hope it flows. But please try and explain to us, why is everybody so reluctant, especially your traditional investment houses like Old Mutual and Sanlam and so on?
Hopefully next you'll ask me about performance, just to make it truly challenging. Now, I think my honest opinion, this is a Tiaan Herselman opinion, because you're asking me what I think about investment houses, and we are an investment house. But Corneille, I think if you look at where a lot of wealth is concentrated, if you simplify investment planning 101, you have more risk when you are drawing an income than when you are investing. Because when you're drawing an income, you're actually selling units. When you're investing on a monthly basis or towards a goal, if markets go up or down, you don't worry because you're looking at the average, right? And as long as the average number is what you're looking for, then you're fine. When it comes to alternatives, and I don't think the word is scared, I think what you look at for alternatives is investment houses going, I would love to expose more capital to alternatives, and we've actually done it. We have solutions that incorporate hedge funds, private equity. There's all these things that we are putting into portfolios. But when you look at where a lot of wealth is concentrated or when it matters, is when you start drawing an income. And the one thing we just want to be sure of is the moment you start drawing an income, let's say as a retiree or any person that needs access to capital, there aren't these massive swings. So think of gold as an example. The gold price is up 100%. Why? We've seen a weaker dollar. That's good for commodities, et cetera, et cetera. And now everybody wants to invest in gold. And I mean, gold has had a phenomenal run. But are you willing with the up and down sides? So are you willing to accept that if gold is up in 1 year 100%, it probably can also fall by about 60, 70% as well. So it's not that we don't want to invest in them. I mean, we want to get the maximum amount of return we can for clients given a specific mandate. But we also have to manage your expectations in terms of, are you going to need access to this capital over a given period? Okay.
And then I think the other thing with alternatives is why is there nervousness, is they are alternatives and crypto. So if you want really practical, so flipping from the philosopher to the practical, is what are the concerns? Is one is liquidity. So and it gets quite operational. So why is it different? So if my guiding philosophy is get your money a job, I want to understand what the job these things are doing are. And I want to really stress test that before I expose it to clients. So, for me, the alarm bell that always rings is having lived through the 2008 crisis and what caused that, and mortgage-backed securities, which were these clever things that wrapped things and did things and then basically resold them, and it went wrong. So I'm always thinking of number one rule, don't lose your money, don't get wiped out. And then you can be creative. But within that space, why I get nervous about some of these things is we're learning, right? So anyone, again, going back to overconfidence, who pretends they understand it, it's quite hard when you don't understand something and someone's very excited about it, but it's actually quite hard to understand versus, I always think in investing, I quite like jam factories. It's a jam factory. It makes jam. Why is it worth more? Because it was making a jar of jam. Now it's making 100 jars of jam. When you get to other alternative investments, sometimes it's like, why is this thing worth more? Good question. Should I invest? Well, it's going to be worth more tomorrow. Why? Good question. And so it's that tricky bit where, so package them. You say, what is an alternative investment? It's just something that's a bit different. So I think in South Africa with hedge funds, they've become more standardized over the last decade. And there's guardrails and there's protections in place to make sure that, the fee structures are transparent. We know how they're making money. Liquidity is a big thing. So when, you can add something funky, but then when things go wrong, and the more creative things you do, things do go wrong. So what happens when it goes wrong? How do you get the client's money? And so when it comes to crypto, you want to understand firstly, what is it? And then there's a lot going on in that space. So certainly the nice thing about Old Mutual is I can be a bear, and I am, I'll be honest. I'm super nervous about that space. There are other guys that are super excited and learning and the underlying technologies like blockchain and that kind of stuff, really powerful. I go on for a long time, so I'm going to pause.
No, but I think, but Trevor made a very good point. It is about liquidity, because if you're somebody who's saving for the next 15, 20 years, you might have more appetite for these alternative investments, but we just find it can go wrong and it can go wrong quickly. But as long as you are open to that going into it, but we have a lot of alternative options in the Old Mutual group that are available. So we're not against it, but we think for the right client in the right scenario with the right objectives.
Okay, I'm happy with that. I think for me, in terms of the cryptos and even gold at the moment, I like to be bullish sometimes, but I also believe in that thing that if it sounds too good, it is too good. And I mean, with the gold price that now had this rush, fantastic. But now I get nervous. Now I'm like, how long is it going to continue? And it seems like people only wake up now, so to speak. There's been this phenomenal run, and now that the run has been there, now everybody wants to buy in. And now I think it's a bit late, personal opinion. Yeah. And I think that is the problem that we have with regards to things like cryptos, alternatives, and gold, is that a lot of people, when they want to start in that space, it's already past the run. And this is where I think that Old Mutual is more, I won't say conservative, but more realistic in the way that they do their investments.
Well, I think also it comes back to, and then we can move off the point. Corné, if you're sitting with a client, or I'm your client, and I'm 10 years from retirement, and I've decided, we had a conversation, and I say to you, I want to go into gold, I want to go into Ethereum, I want to go into maybe some altcoins, and I want to go into some kind of a private equity instrument that I might have found. And let's say you convince me that can't be more than 10% of my portfolio. The way we'll have that conversation is, let me show you the upside of this, if it performs at 30 or 40% a year, and let me show you what happens if I take it out of your financial plan. Because then you can make an informed decision. If it's just, well, I'm bullish, Tiaan, I believe in A, B, and C, then that's just based on optimism and just human emotion. And in some cases, like Trevor's more a bear, I'm more maybe a bull who's more optimistic, but we don't know who's right and who's wrong. But as long as we know what the implications are if I'm right and the implications are if he's wrong, then we can both make an informed decision.
Yeah.
And I think the bigger danger in what you're talking about there is make a plan that works for you. And you don't have to have an opinion on everything. And one of the biggest dangers is when your neighbor does well. Because now, like, I think a lot of the pressure is everyone's sitting there, they've got a plan, they're comfortable with their plan, and then they feel almost inadequate because someone else is done very well.
Yes.
You've got to put that aside. You've got to really focus on your own plate, because, like, the challenge in investing is when you start making bad decisions because you're seeing things going wrong or right somewhere else. So, like, speak to your advisor, but, you know, just try and keep it contained. You don't have to have an opinion on everything.
Yeah. Okay, so I wanted to ask you, man, let me ask you this and the other one in any case. In terms of portfolios, and not wanting to necessarily compare Old Mutual to other companies, but if you do go and have a look at some other companies, Peregrine, Everest, Altitude, 10X, Signia, to name but a few, if you look at some of their fund fact sheets and the performances that they've had, it looks like they are outperforming Old Mutual humongously. So the question for me is, how should clients go and evaluate portfolios and fund fact sheets in order to make a decision as to where to invest and why should they use Old Mutual? Because if you just look at it at face value, and that is unfortunately what happens with the majority of people, they look at something on face value, they see Old Mutual Smooth Growth Fund performing at 9.4%, and right next door they see an Allen Gray Balanced Fund performing at 18%. Immediately, that's where they want to go. Why does it sometimes look like other companies are doing substantially better, and how should a person approach their portfolio choices not to get burned, so to speak?
I think this is exactly where most people need help. So it's not a simple, like, tweetable kind of explanation of how you approach it, but make sure you're not just looking at that number and just at that fact sheet. I always say, like, a number is fairly meaningless without numbers to compare it to, and making sure you understand what the number is. And, you know, you'll always get that disclaimer on fact sheets. Past performance is not an indicator of future performance. Most people ignore it. And even advisors. And one of the things I've had to accept is that's not going to change. So however much we educate people to say, don't just chase performance, that's the number one mistake people make.
Yep.
So catch yourself in those moments. If the only reason you're choosing something is because it's a big number, like a red flag must go off.
Yes.
There's, like, the challenge is a retail investor makes decisions typically emotionally, like that, like because the advisor likes it or there's something else. Institutional investors, it's not their money. They're investing it for someone else. So they have a whole process to go through. They don't just pick a fund based on the fact sheet because they'll get fired.
Yep.
So there's a whole thing. You look at the people involved, the process involved, the fees, the performance. Yes, you look at the performance, but it's not just a single number. You look at it over time. You say, okay, that's this year's number. How was it last year? Relative. So you look at these things called rolling returns, like how was the last year for now? You stress test it. When was there a bad period of performance? How did you do in that period? Like, have the people changed? Is it the same team that's been doing it? Has the philosophy changed? So these are all quite, like, if you want a full, intense due diligence, which is a proper kinking of the tires, and then it's not just process, it's also operationally, what are the checks and balances involved? So just on your point, too, like, I don't think that's, within the old mutual fund, we've got lots of funds that are performing well, and we've got portfolio managers that are performing well, and we're exposed to the same ups and downs that other managers are. So there will always be periods where there's someone else doing better. There will be periods when someone else is doing worse, but that's not the only thing you look at any point in time. But we do well.
Can I be a bit controversial?
Please do.
I always struggle with the arguments that this fund is doing better than that fund, and I ask for, well, give me an example. So if you look at the last 10 years, many people took their money offshore. It was kind of the flavor of the, and I mean, look, for good reason, because offshore markets outperformed local markets. Well, over the last 10 years, we have the number one offshore fund in the market on our local platform. It's Old Mutual Global Equity.
Yep.
It's outperformed every single other fund. So you look at that, and we wouldn't go to the market and say, oh, what do you think about the Old Mutual Global Equity Fund compared to Fund A, B, and C? Because that fund has a specific mandate. If you want access to international markets, growing markets, go into this fund if you have a 10 to 15-year time horizon. Over the last 1 year, that fund has underperformed one of our balance funds. So if you look at these two, you go, oh, but our core balance fund, that's a nice low-cost passive fund, has done 20-odd% at this day when we're recording, so that might obviously change. Oh, but the offshore fund only did 12-13%. Oh, so this offshore fund is rubbish. When you look over the last 10 years, you go, oh, hold on, this offshore fund has done phenomenal because my time horizon is different.
Yes.
But the mandate between the offshore fund and the balance fund is different. The balance fund is saying, well, if you go into the offshore fund, understand that over any 12 months, the market could go down 30-40%. And it has. The balance fund saying, I want to take those outperformance years and just limit them a little bit. So I want to have exposure to different assets. And some of the managers you've mentioned, I won't go into them, we actually build multi-asset portfolios or models that have exposure to good models. So our view is it's not just Old Mutual.
Yeah.
In some cases, we think when managing money offshore, we like the Old Mutual Global Equity Fund as a portion of portfolio because it just has, it started in 1995 and it's been the best performing offshore fund, so why change it? In other cases, we like using other managers in funds as well. But the number one thing you have to look at is what is the mandate of the fund? And based on that mandate, over the appropriate time horizon, how was the fund done? If you go back to your example on absolute smooth growth, the mandate of that fund is when markets run and you get this year SA equities done 30%, take some of that portion that's in SA equities and hold it back and give a bit to investors. So if balanced funds or multi-asset funds have given you 20%, we're going to give you 12%. Why? Because we're building up the reserves. Why? Because we know around the corner there's going to be a speed bump or a bumpy ride, and then we'll get you those returns back. But if you go back to 2015 to 2020 and you compare the Absolute Smooth Growth Fund against the balanced funds in the market, it smashed them. Why? Because that's where it's supposed to do well.
Yeah.
So if you just look at the 1 year return, you go, oh, Absolute Smooth is rubbish. It's only done 12%. Market's done 18%. Oh, 100% because we're holding back some of the returns, but when the correction comes, and it will come, you'll be smiling in that fund going, I'm so glad I diversified into this fund because that's the purpose of the fund. So it is very difficult having a performance conversation around the braai when somebody goes, oh, well, my portfolio's done very well the last 12 months. And you go, well, let's have a 10-year conversation. What's your mandate? What's your objectives? What are you doing? Are you drawing an income? Are you building long-term wealth? That's why you can't just look at one number and say, well, that number is larger than this number, without the appropriate context.
And I think the braai conversation is one, as you've seen, we both like to talk and we've got various ways of explaining stuff. What I've had to learn is just to listen or just to shut up sometimes. So you're sitting at the braai and someone says something, there's a lot going on that I want to respond to because you kind of go, oh wow, that's like it's not, you're thinking about it wrong. But you can't just convince them. They have to be ready to explain it, and that's why I'm not sitting here this is why I'm a fundamental believer in the jobs that advisors do, because that's what you're trained to do, is to sit, and it's not a single conversation either.
That's true.
I think a lot of people think they're going to go to an advisor, and actually some people try to do this. They're tricky. They go to an advisor and they don't actually intend to take that advisor on as an advisor. They go down the line and then they go and implement themselves, and then they're misunderstanding what it is. Advice is conversational. So it's going to take a long time. There's nothing we can do on this video to explain how you need to approach that.
But the one thing we can say, which is 100% true, is you never bring chicken to a braai. That's just, you don't do it. Let's be honest.
Yeah,
No matter
exactly.
where markets go, we all agree you don't
gee.
bring chicken to a braai.
There we go. He's answered it. And get your money a job.
Gents, I know we have to wrap up now, and I do apologize, but I'm going to steal 5 more minutes because I've got 2 more questions that I really, really want an answer on. Expats. Lots of expats that I get to deal with these days, hence the reason I wanted to speak to you about OMI because of the products. I think OMI's got some of the most fantastic products, especially the endowment. But expats, lots of them are coming back to South Africa. They're not immigrating, they're just working overseas and they're coming back. They all want to be back in South Africa. Now, if an expat is internationally investing, 2 questions basically. Number 1, is it still of value for them to make use of retirement annuities in South Africa? And number 2, should they be bringing back their money that they have invested internationally?
So, I mean, I was over for two periods, once 98, 99, and then I went to the UK for 12 years. So I'm in that category of people who came back 5 years ago. There's no simple answer because it depends what country you're talking about, and it gets quite specific. In terms of bringing your money back, you don't necessarily have to bring your money back if it's already offshore. So like for myself, when I came back to South Africa, I had my share portfolio and I then put it into the wrapper because now I wasn't a South African tax resident. And so this is where it gets complicated because you're talking about product, whether the product is right, you need to know what country they're from, you need to know the specifics of their situation. What we always try and say is make sure you get your affairs in order before you get on the plane. Because quite often people just go because they make you'll be amazed how quickly these decisions get made. I came back and the decision, and when we were here, was all during COVID and people weren't working and it happens quickly. So have the discussions up front because it actually matters literally like where you were, when it happened, what your tax residency is. And this is exactly the kind of case where don't make snap decisions. Talk to specialists, get the right advice, and make it based on that. But there were 2 parts to it. So you were saying?
The first one, if
Retirement
they
funds.
should bring their capital back, and secondly, should they still be making use of retirement annuities, considering the fact that they will eventually come back to South Africa sometime in the future?
And then, I mean, I'll get Tiaan's view on that, but again, that's almost like where it matters. So for me, I focused on international. I didn't build up big retirement annuities because I was working in South Africa early, and so I didn't have that in it. So do you have those existing? It matters. Like, do you have it and then you move over, and then what do you do when you leave? Are you going to leave those? Is it appropriate to leave it in? So it's not an easy question to just answer as this is the general rule.
Yes.
I need to sit down, see the clients, what are their intentions. And this is actually one of the challenging things, is people think our intentions are fixed in stone. Is actually sometimes I don't know what I'm going to do. I don't know like what's going to happen in 5 years. So you have to build some flexibility in, but just try and be aware of the consequences of your decisions. And that's where you pull in a specialist advice, and it might be legal advice, it might be a fiduciary specialist, like thinking about, have you got, so one example is, I now have set up a UK will. Because actually I'd have a South African will and a UK will. Because actually if I have property in the UK, I need a UK will for that because the South African will doesn't apply.
That's correct.
If your will is not up to date, and you'll be amazed how many people, their wills are not up to date, it causes problems.
Oh, yeah.
So this is where an advisor, even if you're an advisor, can help because they make sure that you're having that conversation every year. You're checking what are we missing, you stress testing it. It's not a once-off solution because life changes and you've got to adjust to it.
Very, very true. Absolutely.
Yeah, I think I'll just quickly add, just because of time, but I think the one big question to Trevor's point is, have you financially immigrated? So are you still a tax resident in SA? Because that changes everything. If you financially immigrated and you don't have any plans of coming back, then obviously why would you put your money into retirement funds here where you are limited the money has to pay out here in some cases in retirement. But if you are planning on coming back, there is still a big case to be made for disallowed contributions on retirement funds, whereby if you're not getting the tax benefit now, you can defer that into retirement, draw tax-free income up to the disallowed contribution. But I think Trevor hit the nail on the head. It really depends on your circumstances. And these are the things where value of advice, like where having a financial planner is to me instrumental because people make these decisions very quickly without thinking about the implications. And then you kind of go, oh, but I'm no longer an SA tax resident. Oh, but I'm going to come back. I've got to redo all of that. I can't get access to certain products now again. And it becomes very difficult to fix afterwards. So I would say the bulk of the work gets done as to the question, am I going to keep my SA tax residency or close it off? And because that has a big implication to the question you've answered us.
Last question, absolutely. With the rise of AI, ChatGPT and all their friends, do you think there is going to be a position or a need for financial advisors 5 to 10 years from now?
You're talking to the right two people. Both Tiaan and I are very passionate about this, and actually, this is where you're saying we make a good couple in this, being able to talk about these things. Look, it's an open question. Like my wife's an anthropologist, and she thinks this is what do we think is happening? We're fundamentally human, and this is not going to change. This is just another tool. We've had lots of technology going in the past. I get torn between two. So I've read this book, Deep Utopia, which is like the really optimistic thing, and I get all excited. And then the other one that I've just read is if anyone builds it, everyone dies. So that's like as extremely negative as you can get. I think everyone's going to have a natural tendency to defend themselves. Like we all want to believe that we have value. My brothers are both doctors. If they were told after 20 years of study that this new tool does what they do, and like that's an existential crisis. You're off the thing. So I don't know is the fundamental answer. And I think anyone who tells you they know for certain needs to do some reading. I think what financial advisors do is very human, and it's not necessarily scalable. These conversations that I was saying, there's no single answer that meets all, and I think the last things to go will be the things that don't scale.
Yes.
So like a human connection, and the one thing that AI doesn't do is reciprocity. And the heart of financial advice is actually a relationship.
Yep.
It's a two-way thing. You connect with your financial advisor. You cannot connect with AI, and it's a very important thing to remember because it's going to seem like you're connecting to AI. And so I think the guardrails for us to protect ourselves will be to try to keep that and to remind ourselves it's not human and the importance of being human, and that's a fundamental part of being a financial advisor.
Good.
For the sake of time, I'll tell you absolutely not. But I do think a lot of financial planners are going to be replaced in the next 10 years because they don't leverage the efficiencies of AI. And I don't think it's because AI will replace what they are doing. Their businesses just won't be built or won't be run as efficiently as it can be run.
Yes.
That's my very short answer.
Yeah.
But to Trevor's point, none of us know, but I really believe that there is such a place for financial planning and the value of a financial planner. And I mean, I'll be honest, I've tested, I spend way too much time on these models just for my own benefit, but there's a lot of constructs it still struggles with. So as an example, do I put the money into a local offshore trust, tax efficiencies, different structures? There's a lot that it's still grasping with. Can it figure it out? 100%. Can it get somebody to act with conviction and take emotions out of decision-making? That's where I don't think it will ever get to that point in time.
So, gents, we're out of time. Thank you very much. We have to wrap it up, and I hope we can do this again soon. Thank you very much for your time.
Enjoyed it, Corne. Thanks.
Always great being here. Thank you, Trevor.